Purchasing real estate for income purposes seems like an easy way to get rich quickly. All you got to do is buy a property, find some tenants, and then collect those rent checks month after month after month. But there are some things that you need to know prior to becoming a landlord. So I'm going to give you 5 steps that you absolutely need to take before jumping into the rental income game. And we're getting into it right now. Hey everybody, Dietric Williams, realtor with Compass in Baldwin Hills, California, and welcome back to another edition of Info on the Go, the show where I give tips, tricks, and insight on how to buy, sell, or invest in real estate in Southern California. If that sounds like something you're interested in, please make sure you hit that subscribe button and ring that bell so you're notified every time I upload new content to YouTube. Step number 1 is figuring out the area and the type of property that you want to purchase. Do you want to purchase in the city or the suburbs? Are you looking to purchase in state or out of state? That may make a huge difference because it may not be cost effective for you to purchase in your own backyard. And there may be some better deals out of state, but there are some risks that go along with that. So you have to decide whether you want to be able to drive to your rental property or you're going to have to fly and maybe make it a week or a weekend trip to go check on your property. Also, do you want to purchase a single family home, a condo, a townhouse, a duplex, triplex, or a quadruplex? Each one of those is going to have different price points, different rent rolls, and just the overall dynamics of managing those are going to be different. Before you dive into real estate investing, you need to be very clear on what your long-term goals are. As my friend Jamal King, the 9-to-5 millionaire, says, you need to have a purpose for every property. Step number 2, and many of you are probably not going to like this, is you need to know the numbers. I know you probably hated math, but this is no time for your personal feelings about math to come into play because this is a logical decision, not an emotional one. So you need to figure out what you're going to pay for that property. So what's the purchase price? You have to calculate the taxes, the fees, closing costs. All of those things are going to come into play. Also, you need to know what the rents are going to be. So looking at a site like rentometer.com and just plugging in an address will give you some indication as far as what the market rate rents are going to be in that area and what you can charge. You also need to take into account what you're going to pay in terms of your mortgage, or what we call debt service. Is a unit going to be vacant? So what's your vacancy rate? And you can get that from the previous owner or just with a quick Google search, because you probably won't have a tenant in place every single month after month. There will be a time where the unit will be vacant, especially as you're transitioning from tenant to tenant. What are your monthly expenses and how are they increasing each year? Things like repairs, management fees, different costs. All of these things are going to increase each and every year. Now, why do I say that? Because we have something called inflation. So the price of all of those services are going to increase. All of these things will eat into your profit margin. So you have to pay particular attention to how your expenses are going to affect your bottom line. Now, once you figure out what your gross income is going to be on a month-to-month basis, in other words, your rent, you're going to subtract out the monthly expenses, not including your debt service or your mortgage. That's going to reveal a number called your NOI, or your net operating income. You're going to take that number, divide it by the value of the home or the property. In this case, it would be the purchase price that you're going to pay. Divide it by that number, and it's going to reveal something that we call the capitalization rate, or the cap rate. Now, the cap rate is something that investors use to measure the profitability of a real estate investment. Typically, those numbers are going to vary depending on the location, the type of property, so on and so forth. But typically, you want to see a cap rate that's somewhere in between 6 and 12%. However, you got to keep in mind that this measures risk. So the higher that percentage is, the riskier the investment is. A better metric to use is cash on cash return. Now, it's essentially the same formula. So you're going to take your gross income, you're going to subtract your expenses. This time you're going to include your debt service or your mortgage payment, divide that by the value. That'll give you a percentage called your cash on cash return. Why is this a better metric? Well, it's really kind of up to you, but I like to use cash on cash return because it measures real life scenarios. For instance, you have to pay that mortgage. So that's an expense that you need to account for. And that's why I personally like to use cash on cash return. Step number 3, don't put all your net income into your pocket. Now, whether you rent or you own, things inevitably break or they need to be repaired. And as the landlord, guess whose job that is to fix all of these things? That's right, it's yours. So you want to make sure that you are saving up for a rainy day, just in case that water heater breaks. You don't want to have to come out of your own pocket to fix that. So what I like to tell my tenants to do, or what I like to tell my investors to do, is to make sure that you put 50% of that net income into a reserve account so that you have those rainy day funds just in case there's an emergency repair that needs to be made. Now, that's a smart business move because it's better to have it and not need it than need it and not have it. Step number 4, understand local and state laws. Now we're talking tenants and landlords here. And why is this important? Because as a landlord, if you don't understand the tenant and landlord laws, it can cost you big time. I'll give you an example of a local law. So my first real estate investment, I bought a condo in Georgia, and I thought originally I was going to move to Atlanta, but things changed. This was just before the recession hit in 2008. So all the plans that I had didn't go through. So I became a de facto landlord and real estate investor because of what happened in the market. Well, I was paying essentially a mortgage in Cali and a mortgage in Atlanta. Yeah, you could figure that I was kind of bleeding cash. So I decided I needed to find a tenant. I needed to find a tenant quick. Well, when I went to go get a tenant, the condo association told me, hey, in the CC&Rs, which you will get if you purchase a condo or in an HOA environment, you have to be placed on a wait list in order to rent out your unit. And then once you come up, you have 30 days to find a tenant. Otherwise, you go back on the wait list and you go to the bottom of the wait list. And one of the pains of being a landlord in Los Angeles is rent control. So wherever you're at, you want to understand whether there are rent control laws. And essentially what that does is protect the tenant from the landlord increasing the rent. You can only increase a certain percent every 12 months, and you also cannot evict without just cause. If you violate any of these laws, you could be hit with a hefty fine, and that's another unneeded and unnecessary expense. One of the other things that you may run into is you may be forced to pay certain taxes or special fees or assessments as a landlord. So you just want to keep all of these things in mind. So understanding these tenant and landlord laws and regulations from a local and a state perspective is going to be very important, because you don't want to get caught off guard and have to pay for something that you didn't account for. Step number 5, hire a property manager. Now, if you're a renter, chances are you call the landlord in case of emergencies. Well, guess what? Again, now you are the landlord, so people are calling you. And unless you want to wake up at 2 a.m. to go fix that busted water heater or an HVAC system that's not working properly in the middle of winter, you probably want to hire somebody to take care of all of that stuff for you and manage the property. Now, you're probably going to want to be hands-on if this is your first income property. Rightfully so. You're going to want to save a little bit of money. But if you work a 9 to 5, you're not going to want to get all those emails, texts, phone calls, voicemails from tenants who may be a little bit irate and demanding, wanting you to come fix some things right now, then and there. Even if you're not 9 to 5 employed, if you're self-employed or you're semi-retired, you still may not want to deal with all of that stuff. So I would suggest you hire a highly qualified property manager. Notice I said highly qualified, and they're typically going to run you 10% of whatever the rent is for that unit or for the building as a whole. But trust me when I tell you, they are well worth it. Now, there are a lot of additional things that you also want to keep in mind before jumping to the real estate investing game. For example, during the pandemic, the government issued an eviction moratorium and some tenants were not paying rent. And this has affected many investors even to this day. And there was no game plan for that, but it's still something that even now you have to keep in the back of your mind as what could happen, especially if you're jumping into the game now. If you buy a rental property now, you might be jumping in and somebody could claim a COVID related issue and not pay you the rent that rightfully you would be due as the landlord. But these are just some basic things to give you an overview and how to get started in real estate investing. You want to pay particular attention to step number 2 because it could be the difference between building wealth and being wiped out.